Welcome to Alternative Investing. I'm Brett Harris, sitting in for Mark Bunting, and with me is co-host David Kaufman, president of Westcourt Capital. This is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. And tonight, we're going to take a closer look at alternative strategies using ETF products and how you can use them to protect or enhance your traditional investments. David, great to see you again.
Good to be here.
What is the case for alternative investing? What's the rationale?
Yeah, let's remember why it is that we talk about alternatives every week, and we have a board for this. And any devotee of this show, this will sound a bit like a broken record, but the first thing that we're looking for is a decorrelation from the public markets. And anyone that's been following the public markets in recent days and weeks certainly understands that the volatility of the public markets is not something that they necessarily want to experience in their whole portfolio. And then we look for absolute returns, which is a fancy way of saying that you want to make money in any market. Hedge strategies to reduce volatility. That could be by way of option overlays, long-short strategies. The idea is that you can't win all your bets, but by having some bets that hedge your long bets, you can lose less in a down market. And finally, it's very important to have inflation protection in your portfolio because most people agree that inflation at some point will come back, and you want the purchasing power of your portfolio not to suffer when that inflation invariably comes.
All right, let's talk about a lot of the strategies that we've covered are available only to accredited investors or even to the bigger, like the institutions.
That's right. So high net worth investors and institutions are able to access alternative strategies directly or through funds. We have hedge funds, private mortgage funds, private equity, private high yield debt. You keep hearing the word private come because these are limited partnerships or certain kinds of trusts that are not publicly traded. And they do exhibit most of the characteristics that we're looking for, but unfortunately, they're not available to the general public, and so they're of very little use to the average investor.
And when we're talking accredited investors, what's the threshold here?
The easy way to look at it, especially in the province of Ontario, is someone that makes $200,000 a year or has $1 million of financial assets, or if they're lucky enough to have a net worth of $5 million, then they're accredited for sure.
What about some publicly available options, though?
Historically, sort of pre-ETFs, there were ways to protect your portfolio. You could achieve some of those characteristics that we talked about off the top, but not all of them. So we have public REITs, mortgage funds, and income funds, principal protected notes, seg funds, real return bonds, and some of these attack inflation, and some of them attack some of the other characteristics that we talked about. But the problem with those, there's really two issues. The first is that the public REITs, for example, are invested in real estate, which is an alternative asset class, but because they're public, they tend to have very high correlation to the public market. So it's sort of like you're back where you started. The other problem is that they're very expensive. And so in some cases, I believe, for example, in the case of seg funds, that you're paying a very high insurance premium for something that is unlikely to occur. And even if it does occur, the premiums that you've jacked up along the ways may add up to more than the protection that you receive in the end.
Okay, so I'm a non-accredited investor. What am I going to do?
I think the answer really is what we're going to talk about today, which is using ETFs to access alternative strategies. And there's a number of different ways to do that, which we'll cover today. But the idea is that you can have access to commodities and managed futures, tax-efficient income, infrastructure, and we'll investigate today how that's possible.
All right, interesting stuff. That's still coming up. Stay with us. We'll be right back to look at how to use ETFs to enhance your traditional investments. Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital. This week, the topic is using ETFs to protect or boost your more traditional equity investments. And joining us tonight is Som Seif, president of CLAYMORE Investments. Great to have you with us today.
Great to be here.
Let me just ask you at the outset, what do you think of alternative investments? What's your take?
Well, we're a big fan of alternatives, and when we look at alternatives, we think of them as really important components of an overall portfolio. But there's a lot of things that are very important. I mean, first off, we don't think alternatives should be bucketed as, call it, alternatives, because, alternatives themselves have so many different varying factors and risks and exposures and correlations. So some of which have equity correlations, some of which have non-equity correlations, some of which have inflation and currency exposures. So it's very important to understand the actual underlying strategy of the alternative. The second thing that's very important within alternatives is our perspective is that there's really liquid ways and illiquid ways to get exposure to alternatives. As you guys sort of set out at the beginning, most of the alternative products that are out there are really illiquid strategies, meaning they're private portfolios, they're buying private assets. And to us, there's a value in that. The problem is that you have to deal with that, or receive a liquidity premium for getting rid of that liquidity benefit.
Right.
So we think that there is a benefit, but you have to get that liquidity premium. And the final thing with alternatives to us that's very important is that just like all asset money managers, we think alternatives have good managers and bad managers. And, you know, unfortunately for a long time, because alternatives were a new asset class, most people were really able to charge big fees for giving this alternative, call it beta, market exposure. And what we've recognized is that a large part of the money managers who are out there who are giving alternative beta but charging alpha fees just don't deserve it. So our view is that there is a really good opportunity to bring liquid beta alternative beta to the marketplace to allow investors to have exposure to this asset class.
So in other words, go ahead and pay for the alpha if it's there, but if you're going to access beta, you should access it as cheaply as possible.
That's right. I mean, in any asset class, you should always access beta as cheap as possible. And I think, David, as you agree, you pay for the guys who really add the value, and you pay whatever they're going to charge you to get you the end value appreciation over above the markets.
All right. Well, in your case, we're talking about ETFs here as a really value-oriented way of getting into this kind of market. So let's start off with something that's really topical, which is, of course, gold. Gold prices have run up. Everybody's looking at gold this week, and you've got a gold ETF.
Well, I think the one thing that's very important in gold is that, I mean, gold is an asset class that is, you know, you can argue that it doesn't have much value because of it doesn't pay income and things like that. But to us, gold is an important asset class for portfolio benefits, diversification, all the rest of it, and also just risk against other market dislocations. And the reason we have gold doing what it's doing right now is because there's a lot of fear, you know, around whether it economic situation, whether it be currency situations, and people are gravitating to gold. And we think that's an important thing within the component of the portfolio. But it's got to be limited. You can't have gold be 50% of your portfolio.
So speaking of which, so when you say it has to be limited, I mean, if you're hedging your portfolio, it has to be limited. How much do you see in the influx in ETFs that trade directly in actual gold bullion? Do you see speculators taking part in theirs? And what role does speculation play in gold trading?
Well, I think in any asset class, there's always going to be investors and there's speculators. So gold is no different. And so what we're finding right now is that, you know, gold is seeing people out there who really think that, you know, we're going to play this and drive this and do what we can to ride this as long as possible. And they're not really long-term investors. The moment they see a downturn in gold or whatever they're going to be out of there. But there's really a large component of long-term investors into this asset class. And that's one of the things that's happened over the last decade is more and more people have recognized the value of gold within the context of correlation benefits of a portfolio. And that's really been an important driving force of investment demand.
Let's talk a little bit about CGL and the advantages that investors would get with that particular ETF.
Yeah. Well, CGL is a gold bullion ETF. It owns physical gold bullion in an allocated form, so it's actually got a stored vault with all the gold sitting there. It trades on the Toronto Stock Exchange, and we offer both a hedged version and an unhedged version, so that, you know, you can take away risk of currencies in U.S. dollars, or you can, if you like the currency, you can take it. The big thing for me, though, is when you look at CGL or gold ETFs, 7 years ago, you know, there was no real ability to go out and buy gold other than going to your local bank and saying, I want to open up a safety deposit box and store gold there. Today, you know, because of things like CGL and GLD and other products like this, gold can be bought and sold just like a normal stock. And that's one of the great benefits of ETFs. It's, you know, this innovation that's been brought to the marketplace that allows investors to get access to these asset classes that were sometimes very difficult in the past.
And even if 7 years ago, before you had the ETFs to do this, the price of gold has changed, of course, since then. But there's this issue of storage, of course. And so, you know, you don't keep it in your basement. Somewhere someone has to have some safekeeping for this. So I'm guessing that the people who access gold through ETFs, including institutions and very high net worth investors, are not spending any more than they would to have to store it themselves.
Exactly. I mean, if you actually thought about the cost of going and buying gold and either the cost of safety deposit box, you're paying $12 a month for a safety deposit box. When you actually look at that in the context of $1,000 or $10,000 of gold, that's actually a pretty expensive management fee, you know, or a storage fee. So it's no different than buying an ETF. So, you know, most ETFs trade anywhere from a fee of 25 to 50 basis points, so 0.25 to 0.51 of a percentage point. So it's not that expensive when you think about the actual cost of storing a physical asset like gold. in this context.
We've had such a huge run-up in gold prices, obviously. The big question, I guess, is this a good time to buy in? Is there still a lot more room to run?
Well, we're very bullish on gold as a firm, and the reason is not because of inflation-adjusted prices of gold being below historical levels. It has exclusively to do with people are very worried about this economic situation, but more importantly, the currency situation. You got a denominator effect issue.
We should move on to the commodities ETF as well, because that expands. I mean, there's a little bit of gold in there, but you're getting a broader exposure. This is CBR.
Yeah. Well, to us, when you think about gold, that's one commodity, and to your point, you got to look at things that are the commodity space in general, and that's a great alternative asset. Commodities give you an alternative beta. It's a different beta than traditional equities will give you.
But if I'm watching right now, I'm thinking, well, wait a minute. I have mutual funds that have large cap Canadian equities, which means that I, if anything, might be overexposed already to commodities. What's the difference between equity commodity exposure and actual commodity exposure?
Well, very good point, because a company that it produces a commodity or mines a commodity is going to be much more focused on the market multiples. So it's going to have a high correlation to the market itself. Over the long term, will have a correlation to the commodity if the management is good. And really, when you're buying a company, you're buying the ability for management to create a spread, a margin on that asset or that commodity. When you buy the commodity itself, you're buying the cyclical exposure or the component of that asset and the long-term value of that asset. Now, with commodities, it's very important because you've got a cyclical asset generally. You've got something that's priced in U.S. dollars, so you get a denominator effect. So if you believe that U.S. dollars are going to decline, or you have inflation, then commodity prices should rise. And the third component is you have a supply and demand function, and those three things drive commodities. But the good thing about a broad basket like CBR is that it plays both all three of the sort of the energies, the metals, and the agriculturals all into one portfolio. So you get the benefit of all three areas playing together.
And quickly, that is a managed portfolio, right? So it's not just a straight-up portfolio. You can go long or short depending on what's going on.
Yeah, long only. It doesn't have short. It has a long or flat, as we call it, meaning it can actually have a zero position in a commodity if that commodity is trending downwards. So it's a very important component.
And just to be clear, these are all futures backed.
Right.
We're not talking.
Yeah.
Okay. So
and you got to. It's a very important point because futures. Getting spot commodity price. Even when we talk about gold, you got a storage. You're not getting spot. You're getting spot minus the cost of storage.
Okay.
The storage is very low, but with futures, it's the same thing. You have to remember, spot is a very unattainable price.
All right, we're going to take a quick break and come back and talk more about this because we've got lots more interesting ahead. Stay with us. Som Seif of CLAYMORE Investments will have more ideas about how to use ETFs after this.
Kaufman is one of Canada's leading experts on alternative investing. He's the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital. Back with us again is Som Seif, president of CLAYMORE Investments, and we're talking about how to use ETFs to protect and enhance your portfolio. So we've already talked about some pretty interesting gold, getting into a broader array of commodities. What about bonds here? You've got a short duration, high yield ETF. This is CSD.
Yeah. Well, I think when you talk about fixed income, you talk about interest rate spreads and risks of what's going on in the marketplace with rates and all the rest of it. But you also have corporate spreads in terms of what's happening with companies and all the rest. What CSD is really focused on is it's a corporate bond portfolio, but very short duration. And the way we've actually run this portfolio, the reason I say it's an alternative is because we've actually been running this in also a long-short bond portfolio as a money manager. And we've found that this portfolio actually trumps our long-short strategies because of the fact that it gives you a very short duration exposure on the front end of the curve of interest rates, but has corporate risk. And what you're doing is you're managing the corporate interest rate risk and spread credit risk.
Let me just cut you off there to remind everybody why it matters that it's short duration. We had a couple weeks ago, we had Mike McBain on talking about why long bond investing was probably for suckers at this point in time. And the reason that we discussed was that any long duration, any increase in rates, especially at the end of the tail, was going to have a significant detrimental effect to the value of that fixed income. But you have short duration, so you actually have a direct relationship?
That's right. Well, with short duration, what you're basically doing is that short duration is shorter duration to the markets, not short the actual market. So short duration ultimately is saying that, look, when interest rates rise, your portfolio isn't going to have the same sensitivity to that interest rate rise. Your price of the bond isn't going to go down relative to the interest rate rise in the market. Because as you know, interest rates going up has an inverse relationship with bond prices. So you're really trying to manage around that. And that's a very critical component of bond investing as you look for it. Which McBain was saying is that, if you're a long bond investor today, we don't know when, but at some point interest rates are going to start to rise. You're not going down much further, but they're going to likely start to go up. In the last couple of weeks, it's looked like the opposite, but it's going to go up at some point. And so for that reason, you really want to, on the bond side, stay on the shorter end of the duration aspect. There's not a lot of yield there, but with something like CSD, you're actually getting a very nice pickup in yield today.
And one way you get that pickup is by, as you said, engaging in a little bit of credit risk. And so what kind of methodology do you have in order to be able to measure and manage that risk?
Well, this is an actual portfolio that's managed actively by our partners, Guggenheim, which is one of the best managers of credit in the world. And what they've done is they've really focused on the bottoms-up approach of credit money management. And they've managed these types of portfolios for some of their largest high-net-worth clients for a long time. And it's a great strategy for really giving you, that yield. But if you manage the credit right, you can do extremely well over the long term.
And let's briefly touch the third rail of fixed income investing, leverage. Is there any?
No leverage. And that's the beauty of what we do in the ETF form. Generally you're getting transparent, low-cost portfolios without leverage, and you can actually see a really nice return without the risks in the markets.
And you're getting an inflation hedge.
That's right.
As well.
When you have a short duration or a floating type of exposure to the marketplace, what it is that you actually have that inflation hedge embedded structurally into the portfolio exposure.
And do people realize whether it's denominated in U.S. dollars or Canadian dollars, they're making a directional bet one way or the other? How much do people think about that on the way in, and then do they use other ETFs that you might offer in order to hedge that currency risk?
Yeah, we absolutely. Whenever you buy, when you're talking about fixed income, we actually take the perspective, as soon as you buy a non-Canadian bond, you are playing currencies. That's what you're doing. When you buy U.S. bonds, you're really playing a U.S. dollar return, not an interest rate market. Same with global bonds or anything. So Canadian bonds is really where people should focus most of their attention, unless they hedge out that currency risk. And we actually see, whether it's bonds or equities, we see a lot of people hedging currencies. Our gold ETF has a hedge against it. It's very popular as well.
Let's talk about infrastructure if we can. Global infrastructure, CIF, another really interesting product.
Yeah. Well, to us, one thing about ETFs is very important, and when you go into the liquidity concept, you're buying assets that actually are liquid and trade and all the rest of it. So in infrastructure, we love the infrastructure space. We think that there's enormous opportunity for investors over the next decade in the infrastructure space because of the fact that you've got a really nice asset, whether you're buying airports or toll roads or whatever it be, those are really non-correlated assets over the long term. But two is, the infrastructure construction business. So, companies that are out there, building and rebuilding and some of the utility companies. So we think there's a really nice play there. But what we've done in CIF, it's really a focused public infrastructure company business. You're buying companies. The one thing that's important here is that you are buying public companies, so you do have a little bit more correlation to the markets. But all that is you're buying the same kind of companies that a CPP, Canada Pension Plan or Ontario Teachers is doing when they buy a private, a toll road in Brazil or anywhere else. The difference is that we actually value it every day.
Right. Let's talk about that because it's interesting. When I look at investors' portfolios, they're often they have exposure to equities which far exceeds that of institutions. But on the flip side, you see institutions. Where do they go with their private equity? They go all over the world and they're buying those toll roads and hospitals and highways that you're talking about. And so do you see an increasing appetite now for things that actually generate cash flow, such as a toll road?
Oh, absolutely. And I think it's really in the search of really nice assets that are stable cash flows, that are long-term in nature, that have a long-term appreciation potential. And I made at the outset that comment about liquidity premiums. When Ontario Teachers or CPP goes out and buys that asset, which is illiquid, because if they ever wanted to sell it, they'd have to go into an auction process. They can't do it in an hour. Ultimately, what that means, they have to be getting a premium to that public company that's trading.
Right.
And that premium is ultimately the liquidity premium that they're going to get for buying a private company.
When we were talking about the high yield, we talked about the fact that that was a managed product. Here, rather than picking those stocks yourself, you're actually using an index. And can you explain how that index is formulated? Like, am I really getting the right exposures?
Well, it's really important. But first off, most ETFs are passive or index-oriented, and specifically, this product is a index basis. But one of the things that's different about Claymore and what we've done is we don't believe that benchmark indexes is the best way. So what we've done with this product is we actually use a fundamental factor-based model. We look at companies based on price to cash flows, earnings, earnings momentum, things like that, and really looking at picking the best companies in the infrastructure space based on their factors, their accounting factors, and their growth multiple factors.
I was just going to ask how leveraged this fund is to government infrastructure spending, because, you know, potentially we're going into a period of great austerity, especially in the U.S., and just wondering if that's an issue.
It is and it isn't. I mean, you know, first off, governments have an obligation and a need to build out infrastructure. If you actually see what, you know, both in the U.S., Canada, globally, the need for build-out, there's been estimates of, you know, $5 trillion of global infrastructure spending that has to be done in the next sort of 10 years. It's enormous spend out because we've got an aging infrastructure globally. And so governments, you know, when you talk about tax receipts and all the things that they have, they're balancing the budget. Infrastructure is a major part of the spend, and they're going to continue to have to do that. I think they're going to cut in many areas, but I think infrastructure is about quality of life. But ultimately, this portfolio has all areas. It has assets that are, you know, like I said, airports. It has toll roads. It has construction companies. It has, you know, assets that are, you know, going to require construction build-outs like bird construction, things like that. You have pipeline companies, things like that. So it's a really broad exposure. But, you know, it's not going to be levered specifically to the government.
So you diversify by sector, you diversify by geography, and you use all of that when you build the index. Yeah. How much is one of the factors, or do you generally worry about political risk? You know, when we talk about agriculture, we worry about political risk, the nationalization of certain assets. Is that something that you have to keep your eye on as you look around the world?
It's very difficult to do that in a product like ours when you're doing it passively, because that's qualitative. Political risk is a qualitative decision. Most of the stuff we use is quantitative. And so what we try to do is we believe that you can't be good at qualitatively making those decisions, and you just avoid them. It's a developed market strategy, and so you're going to focus on developed market economies.
I just want to take a little bit of time before we have to go to talk about what you're hearing on the phone. I mean, is your phone ringing off the hook? There's a lot of fear in the markets right now.
Well, you know, it is, and unfortunately, it's a lot of panic in the marketplace. We see what's going on right now as a systematic selling in the marketplace because of, you know, some of the, you know, the triggers and things that are happening out there. You know, there's a number of factors driving it. You've got the fear and all the rest of it. We actually think that investors should step away from this and focus on the facts. And the facts are that things are actually looking pretty good. You got corporate balance sheets that look fantastic right now. You got, you know, in the U.S. specific tax receipts are actually positive. Things are looking very positive right now, and this is a economic recovery. We're moving through it.
And for all those sellers, there's a buyer on the other side. So if I'm in the ETF business, I'm probably not unhappy with the current volatility.
Well, that's exactly. And overall, what you're seeing in the ETF business right now is you're seeing people saying, look, I'm taking money and I'm using ETFs more and more because they really are a valuable asset strategy or product for end investors.
All right. I think we're going to have to leave it there. Fascinating discussion. Thanks to both of you. Great to have you on the show. Som, always good to see you.
Always a pleasure to be here.
That is all the time we have for today's show. If you've got a question about alternative investments, you can email us at alternativeinvesting@bellmedia.ca. I'm Brett Harris. Thanks for watching.